Good afternoon, everybody. One of the reasons, Pascal, in that introduction, and a very kind introduction, thank you. One of the reasons I really enjoyed the session last year, and we'll see it as we wind through this in the next couple of sessions today, tomorrow, and Friday, is the interaction. It's so important for me to take the opportunity to hear what you guys have to say, to hear your views, and through the course of the process, listen to what you say as much as you listen to what I say. If anybody who's paying attention to these sorts of things this morning, you would have seen, as you noticed, there are two speakers today from the IASB. If you pay attention to these sorts of things, you would notice that both of us have no hair, both of us wear a dark suit, both of us have a red tie, and both of us have a pretty much white shirt, which is actually quite similar to our presentation colors. Now, I do promise you that that's completely accidental. There are actually people at the IASB who have hair. There are people at the IASB who wear different colors. You're just not seeing any of them today. All right, the topic I'm going to talk about is actually one of the tougher topics in IFRS, the topic of consolidation and how we pull together financial numbers. I'm going to be giving you a fairly high-level run through it. We've got a limited amount of time, and I don't want to take too much time. I have noticed that the other speakers today have all been really, really good at finishing, not just on time, but in fact finishing early. But what I will say is none of them are important, because I'm the only speaker who's keeping you from going home today. So I am the important one, so I will try and finish this on time. All right, so let's get started. The whole concept of control, the whole idea of the relationship between an investor company and an investee company is dealt with under IFRS by a number of different standards. And the easiest way to navigate your way through those standards is by way of a bunch of questions. So the first question you ask is, does the investor control the investee on its own? And if the answer to that is yes, then we're in IFRS 10, we're in the consolidation standard. Now, because IFRS deals with many different circumstances, because we are principle-based standard and we recognize that things aren't always the same, you don't always consolidate, you just usually consolidate. And I'll talk a little bit about the exceptions. If your answer to that first question, do I control alone, was no, you move on to the second question. And the second question is, do I control with somebody else? Are there two of us in this game? We're talking together, we're managing the process together. If the answer to that one is yes, I'm in something we call a joint arrangement. It's two people working together on something, we're operating jointly in the space. And that's dealt with the next standard, IFRS 11. IFRS 11 in turn asks two questions. Is this a joint operation? Are we actually looking at the underlying assets together? Or is it a joint venture? If it's a joint operation, I go right through, I look right through the thing, and I look at the underlying assets and the underlying liabilities. So I apply all of the IFRSs, because all of the IFRSs apply to underlying assets and liabilities. If it's a joint venture, I apply a standard called IS-28. And IS-28 accounts for something as an investment, but it accounts for it as an investment in a fairly unique way. It says I'm not that worried about fair value, I'm rather worried about how my investment value has accrued, how things have happened in the underlying. So if I'm managing something as a joint venture, then I will look to IS-28, I'll account for that way. But if my answer to the joint control question was no, I have to take another step. And the next step is to say, I now have established I don't have control, because I don't have control on my own, and I don't have joint control. So the next step is, do I have something else? Do I have significant influence? Am I able to affect the way that company is run? Okay. If I am able to affect the way that company is run, I get into the same IS-28, the same place in terms of dealing with it as an investment in this special way. But if I don't have significant influence, then what I'm dealing with is just an ordinary investment. And ordinary investments go into IFRS 9, so they disappear into a whole new category. There's one other standard that's important here, and that's disclosure. We have IFRS 12, which is a disclosure standard, which I'll also deal with a little bit later. And IFRS 12 deals with a disclosure for all of these bottom things. It deals with consolidated, it deals with accounting for the underlying in joint ventures and joint operations. It deals for the accounting for investments where there's significant influence. So IS 12 covers a whole bunch of things at the bottom there. The disclosure standard we have for IFRS 9 is IFRS 7, and that's the issue that Hugh dealt with earlier. That was his topic of discussion earlier. So this session, looking at this slide, we're going to deal with IFRS 10, consolidations. We're going to deal with IFRS 11, joint ventures. And we're going to deal with IFRS 12, disclosure. Tomorrow, Mike Wells will deal with assets and liabilities, so he will deal with that, all IFRSs. And tomorrow afternoon and on Friday, we'll deal with IFRS 9, with financial instruments. That's the universe of what we're going to be discussing. All right, so let's get into it. IFRS 12. It might be worth actually going back to this for a second and just saying one of the things about IFRSs, and I think I touched on this the last time I was here. Up until 2005, the IASB, all the standards the IASB had produced up until that point were called IASs, International Accounting Standards. From 2005, officially, we started dealing with IFRSs, so the International Financial Reporting Standards. So that's where you get this odd numbering that comes through here, IAS 28 and IFRS 1. IASs are the old standards, the IFRSs are the new standards. All of these standards, though, whatever's left of them, operate as a composite unit. So you have to know both IASs and IFRSs in order to understand how the environment works. Slowly, as we go through the process, we're getting rid of the old IASs and replacing them with the new IFRSs. All right, so IFRS 10. Hugh spoke earlier, he mentioned with IFRS 7 that what we do, actually, let me hold that off for a moment. The objective of IFRS 10, the objective of control, is to determine when an investor controls an investee. And we say that happens when the investor is exposed to rights and has variable returns from its involvement with the investee, and has the ability to affect those rights through its power over the investee. So there's a whole bunch of things happening here. In order to have control, you need to say that you have the power to benefit from the decisions you make in the underlying entity. And the next couple of slides, I'm going to try and pull that apart. I'm going to try and define what those different words mean and how they play out in the process. But this is effectively the way that what we would regard as the pillars of control. I have to have power, the first pillar. I have to have an exposure to the underlying control, to the underlying entity. So there must be something happening in the underlying entity which changes my performance. And there must be a link between power and exposure. So those two factors need to be linked. All right, so let's deal with the first one. Let's deal with what power means. But before we do that, and I was hoping Hugh would have left by now, but he's still here, so he's going to see this. It's warm in here. I'm South African. South Africans don't like jackets. People from London love jackets. People from South Africa are not quite so keen. All right, so let's talk about power. Power is an existing right that gives me the current ability to direct relevant activities. Again, a couple of really important words in there. Power comes from having rights. I don't simply have power over any company I choose. I must have some rights in those underlying company that gives me the power to do things. Relevant activities are the activities of the entity that significantly affect its returns. It doesn't help me if I have the right, the power to do something, but that power doesn't actually affect how much money I get out at the end. It doesn't help me if I've got the power to affect something that at the end doesn't change my return on the underlying investment. But it's important that an investor doesn't need to have absolute power. And in many relationships where control exists, people don't have absolute power. And we'll get into a few examples in a few minutes of how you might have power that can be challenged, but you nevertheless have the power to make these decisions. When we talk about rights, we talk about only having substantive rights. Okay. It needs to be rights that actually mean something. It doesn't help if I have rights but I can't actually use them. It needs to be substantive. And to be substantive, it means I must have the practical ability to exercise those rights. And again, we'll talk in a few minutes about a few examples where I don't have the practical ability to exercise the right. But that's important. I need to be able to do something with those rights I have. They also need to be exercisable when decisions are able to be made. It doesn't help if I have the rights today, but the decision is going to be made tomorrow. Or it doesn't help if I'm going to have the rights tomorrow, but the important decisions are being made today. These things all need to come together at the same time. Okay, currentability, another word that we've dealt with. So it's the decisions at the time when those decisions need to be taken. But it's also important, that last sentence seems a contradiction of what I've said up until now. Currentability is not limited to being able to act today. If the important decisions are going to be made in the future, and I am going to have the right to make those decisions in the future, it's not necessarily important that I have the right now. And we'll talk in a few minutes about things like potential rights. All right, so let's get into the examples. An investor has 48% of the voting rights in investee. Okay, 48%, that's not enough to be the absolute power, because 48% can still be outvoted if somebody else has 52%. But in this case, the other shares are held by thousands of shareholders, and those thousands of shareholders each only have less than 1% of the shares. Based on that scenario, we would probably decide that even though the company doesn't have the absolute right, even though imaginably there is some circumstance in which the company can be defeated, the investor can be defeated, we would argue in this circumstance that the investor has control. They are able to exercise their right to vote. And why do we say this? We say this because we know from history that you very, very seldom will find that all of those 52% turn up at the shareholders' meeting. All of those 52% come and vote. So we know that when it comes down to the rubber hitting the road, most of the time the investor will be able to get his way, and he'll be able to get his way on the important decisions. Different example, investor holds 35%, so a much smaller shareholding of the rights in the investee. 3 other investors each hold 5%. Okay, so we're now getting up to 15%. The remaining voting rights are held by numerous other shareholders, each holding 1% or less. Okay, so because they're 1% or less, we're not as worried about them. But now it's getting a little bit trickier, because we know that 35%, plus these other guys holding the 5%, it's harder to make this decision. So now you need to look at a little bit more information. You need to dig in and get a bit more information. So we have a look and we see what actually happens. In order for a decision to be made, you have to have the approval of the majority of those people who vote. And in this company, what usually happens is 75% of people actually vote. So now let me look at my equation. I know 75% of people vote. I have 35% of the votes. Okay. In order to actually win, I need, what is that, 37.5, 75%. That means I can be outvoted. And that means I probably, in this circumstance, don't have control. In a normal voting arrangement, I can't override what's happening with everybody else. I can't actually take control. But if that answer had been slightly different, if I'd said 68% vote, normally I have 68% of people who actually attend the session and 68% vote. Well, 35% actually does give me a majority. It does give me the ability to override the votes of the others in the session. And that ability to override means that I do have control in that circumstance. This is the part that is quite a significant change in the way people need to think about a control environment. In my previous job, I belonged to a company, First Rand Bank, a South African bank. The company was 35% owned by a holding company, RMB Holdings. RMB Holdings never consolidated us. There was never a consideration that they would consolidate us, because they only had 35% of the shares. But 15 years ago, at an AGM that we held, one person turned up at that AGM. One person actually turned up to vote. And the particular person who turned up was a grandmother. Her husband had owned these shares in our company for 35, 40 years. He'd passed away. She had received an invitation to come to the AGM. She had turned up at the AGM because she thought she had to come because she had these shares. We suddenly realized we had this one person we had to deal with, so our chairman took her to tea and we went on with our meeting. Who controlled that company? The person holding the 35%. But under the old principles, under the old control process, our argument was that we only had 35%, so we didn't have control. Under the new requirements, RMB Holdings has to consolidate First Rand Bank. So we had to change. You can hear it's been 4 years and I still kind of talk about us. But First Rand, under the new circumstances, would actually be consolidated. Okay, different example. Investor holds 45% of the voting rights. 11 other investors each hold 5%. There is no contractual arrangement between the shareholders to consult. Okay. Here's a circumstance where you actually hold quite a lot of shares. The investor holds 45% of the shares. But because of the circumstances here, there's a very good chance that you would conclude that you don't control. And you don't control because those other shares, the other 55%, are quite tightly held. Even though there's no agreement, even though most of the time the shareholder with 45% will win the vote, the reality is that they can be outvoted, and they can quite easily be outvoted because there's frequently going to be a circumstance where the representatives of the 55% of the shares will be there. Now, you'll see one of the things that comes through, and there was a discussion earlier with the panel discussion here about the whole idea that you have of principle-based standards. A rules-based standard would say control is 50% plus one vote. Regulatory environments often say control is 50% plus one vote. Here I've told you that I can have 45% of the shares and not control, or I can have 35% of the shares and have control. So judgment is a really important part of applying the standard. Thinking about the judgment is a really important part of applying the standard. What's also important, thinking about Thomas's presentation before, is that sometimes you're going to find that when you're looking at a conglomerate from a regulatory perspective, you might think of something as being a subsidiary when IFRS tells you it is not a subsidiary. Or you might think of something as not being a subsidiary, and IFRS thinks it is a subsidiary. If I hold 35% of the shares in the company and I decide from an IFRS perspective it is a subsidiary, that's not necessarily the conclusion you're going to come to. And it's one of those areas when you're dealing with IFRS financial statements, but you're wearing a regulatory hat, you're looking at it from a bank regulator or a conglomerate regulator or an insurance regulator, you have to be aware that these differences exist and you have to be prepared to adjust for them. Investor holds 40% of the voting rights. 12 other investors each hold 5%. But there's a shareholders' agreement that allows the investor to appoint, remove, or set the remuneration of management. And it takes a 2/3 majority to change that agreement. Okay, the previous example, I said 45% wasn't enough for control. But now look what I've added. I now have a right that allows me to appoint the management. I have a right that allows me to remove management, and I have the right to remunerate management. Now, as everybody knows, if you've got those three things, you control the company. Because, particularly if you've got the right to figure out how much to pay people, because people will listen to the person who's paying them. So in this circumstance, even though you've got less, even though you can be outvoted, the reality is you're dealing with a situation where, in all likelihood, you have control of the situation. And the bottom line is important. 2/3 means 66% of people have to agree to change their minds, have to agree to change the agreement. And 66% in this example can't make that decision because you hold 40%. You hold the ability to block that decision. Another example, Investor A holds 70% of the voting rights. Investor B has 30% of the voting rights, as well as an option to acquire half of Investor A's voting rights. So taken on the face of it, it's clear Investor A has 70%, they've got most of the right. Investor B only has 30%, but Investor B can buy 35%. It can exercise its option to take 35%. So potentially, Investor B has 65% of the rights. Is that enough? Is that 65% enough? Well, now I have to investigate further. I have to say, well, can investor B actually do anything with that 65%? Is that 65% an exercisable option? And if I look at it, I can exercise it any time in the next 2 years, but at a fixed price, and it is deeply out of the money. I'm going to have to pay an awful lot over the odds to actually exercise those rights to get those additional shares. So arguably we would say in this circumstance, investor A probably won't be able to, investor A, sorry, will be able to use it 70%. It's unlikely that investor B will exercise that option to override what investor A is doing. So in this argument, even though I would say investor B has the potential to control, the deeply out of the money means it's probably not going to happen, and therefore investor A actually has the rights. Got investor A and 2 other investors holding 1/3 of the voting rights in an investee, so each of them holds 1/3. Investor A also holds debt instruments convertible into ordinary shares. That right to convert into ordinary shares would allow investor A to have 60% of the shares. And the right is not deeply out of the money. It is out of the money, but it's not deeply out of the money. Okay. Now I'm looking at 3 different shareholders. Each of the shareholders has 1/3 of the shares. But one of those shareholders has the ability to get more shares, and has got the ability to get more shares at a reasonable price. In that circumstance, we would say that investor A has the potential right to override the joint control that's exercised by the other 2 parties. So you can see here why the semantics matter. Look at the difference between the previous example and this example, where all that's changed is that something is now not deeply out the money. It's something I can exercise without too much trouble. So if I have a look at this example, and the first question is the 2 other investors. Well, the 2 other investors probably don't have control because they can so easily be bought out. They can so easily be kicked out of the equation. So imagine this board table. Imagine these 3 guys sitting around the table. And investor A says, I want to do X. And investor B and C say, well, we want to do Y. And investor A says, well, if you don't agree with me, I'm simply going to exercise my right, and then I make the decision anyway. So even though investor A doesn't actually exercise, it has the power. It has the power to threaten the other parties by simply saying, well, if you don't listen to me, I'll just do that. So better you listen to me. That's the better way of doing it. Investor holds 40% of the voting rights of an investee, as well as an option to acquire another 20%. Now, when you look at this example, as I talk through it, you're going to think nobody would do this. Nobody's going to end up with a situation like this. So let's just talk through it, and then I'll tell you what actually happens in practice. So the investor has 40% of the voting rights, as well as an option to acquire another 20%. So they can go up to 60%. So that's the first problem. The option is exercisable during 51 weeks of each calendar year, but it is not exercisable in the 52nd week. So it's exercisable every week of the year, except probably the week when you're actually making the evaluation of whether or not you have control. Okay. People put structures together like this, and they put structures together like this because they're seeking to achieve a particular outcome. The option is exercisable for a nominal amount. So all the counterparties in this equation know exactly what the intentions of the different parties are. The decisions about relevant activities that require the approval of the majority are generally held at other times in the year, not during that important week. You're looking at this scenario, common sense says to you. I look at this and I say, what is common sense telling me? Common sense is telling me that the investor controls the company. They've put in place a mechanism that allows them to pretend they only hold 40%, but they have a way to buy the 20, to get the 20% without paying any money for it. Okay. They have an option, but the option is specifically not exercisable in a very important week of the year. You can see common sense what's happening here. And this explains in many ways why principle-based accounting is so important. Because the principle says, apply your common sense. Think about this transaction. Think about what you're trying to achieve. Think about what the two different parties are trying to do. And the answer probably comes pretty naturally to you. So what we try to do with IFRS 10 in this space is we've tried to apply common sense. Hugh had to answer a question earlier when he was sitting on the panel about the situation that happens, or the reason why something like IAS 39 and IFRS 9 are the way they are, what the big differences are between them. And IFRS 9 is never going to be a simple standard because it's dealing with a complicated underlying subject. But again, the principle behind IFRS 9 is trying to help people apply common sense. The problem with IAS 39 is we try to write a rule for every single circumstance. The predecessor to this statement tried to write a rule for every single circumstance. So all people did was they looked at the rule and they said, how can I get around the rule? I can get around the rule by having this option that's exercisable only 51 weeks of the year. Done deal, I've sorted out, I've got past the rule. The principle says, common sense, what actually works in this space. Right, so let's think a little bit about what relevant activities are. For many investees, there's a range of operating and finance activities that are significant. Remember, a significant or a relevant activity is an activity that affects the returns of the underlying entity. So it's not a significant or it's not a relevant activity if it allows the company to do something or if it instructs the company to do something, but that thing that you're instructing the company to do doesn't actually affect the returns that you're going to get out of the company. Relevant activities are things like selling and purchasing, managing financial assets, selecting, acquiring, selling assets. So depending on the actual activity you're looking at, the relevant activity may change depending on the type of company, depending on the type of investment process that you're involved with. So examples about decisions, operating and capital decisions, appointing and remunerating, and I've said this before, if you appoint and remunerate the people who are making the decisions, that is a relevant activity. You actually do exercising the relevant ability. So let's look at it in a more complicated example. Let's look at it in a situation where you might have to make a difficult decision. Here I've got two investors, investor A and investor B. They form a joint venture, a joint operation, an underlying entity. In that underlying entity, they have different responsibilities. Investor A has responsibility for developing and obtaining a patent of a particular instrument. Investor B must manufacture that and market it. So the two investors, both involved in this entity, in this underlying investee, but they have different responsibilities. And each of them has absolute control of those responsibilities that they're involved with. Obtaining the patent, so the research work and the legal work involved in the patent, requires significant uncertainty and effort. It takes a lot to actually do this. So imagine developing a cancer drug or something along those lines. And when you get that patent, you have 10 years of exclusive use of it. So when the two companies look at this, when the two investors look at this underlying thing that they've created, they realize that most of the value actually is in the development and the obtaining of the patent. The manufacturing and the distribution is the easy part. That just happens almost on autopilot. So if I look here and I look at this on the face of it, I've got two different investors that have control. The one's controlling the patent and the development, the other one is controlling the manufacturing and the marketing. But if I look at this realistically, the important, the relevant activity, the one that will create the most value for the investee, is the development and the obtaining. The manufacturing and the marketing is simply a mechanistic type of thing. So in this scenario, I'm going to end up saying that investor A has control because they are making the important decisions, the decisions that will have the most effect on the return the two investors earn out of the process. You purchase receivables and service them. So investee purchases receivables and services them on a day-to-day basis for its investors. On default of the receivable, the investee automatically puts the receivable to investor A. So let's think about what's happening. I've got an investee, it goes out and it buys debtors and it looks after those debtors. It collects the cash every month from the debtors and it puts them in a bank account. But as soon as something goes wrong, it puts that receivable to investor A. Okay. Managing the receivables on default is where all the action happens. Collecting money, simply going out and collecting money on a daily basis, is a very simple exercise. Managing default, that's where you actually have the ability to make extra money. That's the only activity that it seems like can actually affect the investee's returns. So I would probably look at this and say that investor A probably has control of this company. And has control because it is actually involved in the hardest part of the operation, the part of the operation where the money is actually made in this space. So if you're looking at control here, that's where you would look at. In this circumstance, it doesn't actually matter how big investor A's shareholding is. It might be very small. All you need to look at is how the important decisions are actually being made, how those relevant decisions are being made. Bank enters into a credit default swap with investee B. So the bank has an investee. It enters into a credit default swap with that investee. Under the swap, Bank A pays a fee and all of its credit risk is passed to the investee. The investee issues notes linked to the credit risk to multiple unrelated investors. So this is one of those neat tricks where what the bank has done is it has passed its credit risk on to somebody, and that somebody in turn has passed its credit risk on to a whole bunch of other somebodies. Okay. There are very few, if any, decisions to be made after initially setting up investee. So once you set up the company, it kind of operates on autopilot. It does its own thing. Okay. Neither Bank A nor any of the other investors have any voting rights. They don't need to have any voting rights because there are no decisions that need to be made. This is a simple autopilot mechanism. So what you've got to look at in this type of circumstance, okay, is what happens when things go wrong. You could easily conclude here that nobody controls this because nobody's making the decisions. But you need to look through and see what happens when things go out of sync. What happens when there aren't enough counterparties to pass the risk on to? But you could easily conclude in this one that there is no risk because if I have a look at it, not making any decisions, and importantly, Bank A is not getting any variable returns. It's simply passing all of its risk and all of its risk disappears. Now later on, when we talk about disclosure, I'll talk about the fact that when I look at this, even if I'm not consolidating it, I might be a little bit nervous about what's happening in it. Why am I a bit nervous about it? Because if you look back at what happened in 2008, if you looked at that crisis, all the banks were telling us, we've given away the risk is gone, we no longer have the risk. As soon as the proverbial hit the fan, all that risk came back onto the bank's balance sheets. Suddenly those arrangements that they had worked out hadn't worked. So we accept you really have to look hard here. You really have to understand whether or not control has in fact really passed, whether the risks and rewards have really passed. If you conclude they have, you still need to give information in your financial statements so that regulators, so that investors can understand what that risk is that's gone off and what the chances are that it might actually come back to you. All right, so we've dealt with the first one. We've dealt with power. And you can see how power depends on where that power is actually exercised, how important it is that you have relevant activities, the decision-making is looked at, and you look at the rights that the entities have. We now move on to the second part, which is exposure. So it's not enough just to have power. I also need to be somehow exposed to the underlying returns on that entity. We talk about it, or we define it as exposure to variable returns. If I have exposure to government debt, now maybe I should have said this before 2008, but if I have exposure to government debt, usually what that means is every month I receive a check. My check is the interest. I've got no other variability of returns. It's a fixed process. So I don't really have exposure to variable returns. But other circumstances I can. And in defining what we mean by this, we've cast the net really, really wide. So it might be dividends. That's a very obvious one. If I'm receiving bigger or smaller dividends depending on the underlying performance, that's a variable return. Remuneration. So if I have set a fee that says, and this is a frequent way in the past of actually avoiding this, I set up a special purpose vehicle. I say I have no control, so I'm not actually controlling it, and I have no returns from this because whoever gets the last dollar that's left behind in the company is not me. Now, usually these things that were set up in the past by banks, what we said was that we would have a company and the profit and loss of the company would go to the Guernsey Lifeboat Association. So we would give all of the profits of the company to the Guernsey Lifeboat Association. Therefore, it couldn't be my company because I wasn't getting the profits. But what I was getting was a fee equal to 99.9% of the profits. And that's a fee. It's not profits. We would define remuneration based on the performance of the underlying entity as exposure to the variable returns. That's part of the way you need to think about it. Residual interest on liquidation. So I get nothing out of the company. Nobody else gets anything out of the company. But when the company is wound up, I get all the profits that are left behind in it. That's exposure to variable interest. The next one is an interesting one, tax benefits. A lot of vehicles are set up so that there is actually no profit in the vehicle. It's set up purely to generate tax benefits for the person who set that vehicle up. Well, that's an exposure to a variable return. So I need to look at it and say, if I'm receiving tax benefits from owning that particular vehicle, then that vehicle is mine, that vehicle is a control one. Many, many years ago in South Africa, we were very concerned, and this is going back 25 years, we were very concerned about the fact that sanctions might eventually impact South Africa and might result in the fact that the country couldn't get goods in. So because of that concern, the government set up a policy that said that if you bought a ship, and you bought the ship and you put it somewhere out in the middle of the world, you didn't have any ownership in that ship, but you could decide when the ship sailed from one place to another. Then the ship never appeared on your financial statements, but from a tax perspective, you could write off the ship over 10 years. That was a scheme by the government to encourage companies to actually acquire a ship. 10 years ago, we were able to say, or 20 years ago when this happened, we were able to say, well, we don't own the ship. We don't have any benefit from the ship. We've bought the ship, it's funded, it gets money from sailing around the world, it takes the money it gets and it pays off its loan. No benefit. But we were getting a tax benefit. And the tax benefit would be enough under IFRS 10 to say, I control that company. I get exposure to the variable returns. So these are all the different ways that you can think about variable returns. We're thinking about it a lot broader than simply saying, I get the profits from the underlying company. So an investor is exposed to those variable returns when the investor's returns have the potential to vary as a result of the investee's performance. So when something the investee does, if the investee has a good year, I have a good year. If the investee has a bad year, I have a bad year. You need that relationship to exist. Sometimes those returns are only positive. So I only win in this game, I only get the upside. Sometimes they're negative. So I only get the downside. Sometimes they're both. It doesn't actually matter from the perspective of what we're saying here. It doesn't matter from the way these vehicles have been set up. As long as you have, as long as you have the ability to benefit either on the upside or the downside or both, you have exposure to variable returns. It is important to note, though, that only one investor can control. So if two of you are able to say what's happening, then neither of you have control. You might have joint control. So control as a concept, the one we talked about earlier, is an either or. It's a binary thing. I either have it or I don't. Okay. But returns in an underlying vehicle is not. Many people can share in those returns. So I might have, the simple example is I might have control. That makes me the one. There might be 20 people who share equally in the returns. Only one can have control, 20 can share in those underlying returns. All right, so let's look at a couple of examples. And most of the examples you see in this space relate to fund managers, because fund managers are the guys that generally have these sorts of unusual vehicles, these sorts of unusual relationships where there's exposure to variable returns. So I have a fund manager who manages a mutual fund. Okay. The fund manager determines the policy and the strategy of the fund. I have a single outside investor who owns 55% of the shares in that fund. So now I'm looking at two people in this equation. I've got a fund manager on the one side who's actually making the important decisions, but I've got somebody else who owns 55% of the fund. So they own 55% of the return on that fund. No investor, not even the one owning 55%, can change the strategy of the fund. The strategy is left to the investor manager. No investor can remove the fund manager. So the fund manager's got his job for life. Nobody can take him out of there. And investors can redeem their interest at any time. They can cash out at any time. The fund manager receives a market-based management fee of 2%. So now we've got two people in this game. We've got two people playing in the space here at the moment. The first one is the investor who owns 55%. Under a rules-based approach, I might say that's enough. You own 55% of the fund. You are actually the controller of the fund. But look at the investor. The investor can't decide what the investment policy is. The investor can't decide what the strategy is. The investor can't change the investor manager. There's no control there. So even though in this circumstance we would argue that one party gets most of the exposure to variable returns, that investor doesn't have control, so you would actually say that you probably, that's not the person controlling the environment. So let's look at the other one then. The other one is the fund manager. The fund manager has control because the fund manager determines the policy, the fund manager determines the strategy. The fund manager cannot be kicked out of his job. But what is the fund manager's exposure to variable returns? Well, all they're earning is a market-based fee of 2%. They're not sufficiently exposed to the variability, to the variable returns. They're simply getting 2% of the gross amount. It might be different if they were getting 2% just of the growth, but they're getting 2% of the gross amount. So if I looked at this particular structure, I've got two parties that have exposure to variable returns. One without control, one with control, but its exposure to variable returns is completely negligible. So this is a structure in which nobody controls the vehicle. In this circumstance, the fund manager would not consolidate, the investor would not consolidate. There were one or two frowns around this. I might ask the question at this stage, is anybody surprised at that outcome? Was anybody assuming that somebody was in control here? Okay, cool. The way these are usually set up, and you see a lot of these, I mean, these are regularly. Usually what happens is the fund manager sets up the fund. The fund manager markets the fund. Okay, and very often, and we'll get to an example like that later, very often the fund manager keeps a residual interest. But in this circumstance, he hasn't. And so in this circumstance, even though he's involved in the setup, involved in the process, the reality is he doesn't get a variable return out of it. So okay, and that's important because we didn't say it here, and perhaps we should have had that extra sentence. The fund manager doesn't. So there's 100 other shareholders who have 45%. There's one shareholder who has 55%. But you are very correct, and it's a heck of a good point. If the fund manager owned the 45%, no question, the fund manager controls because they're getting a big chunk of the benefit. And I don't even think they need to own 45%. I think just more than probably 15%, 10% is probably enough for you to start arguing that the fund manager now has control and has exposure to the variable returns. And I suspect that's not, in fact, the next example. Okay, but that's certainly a very valid example. And it's one of the things that you have to do. Again, we talked about judgment and how important judgment is. Now, I know the audit firms, when they looked at this particular thing, audit firms, and I think there are one or two auditors around the room, so I risk having something thrown at me at this stage. But audit firms like to have certainty when they're dealing with this stuff. So at least one of the audit firms, I've read their guidance, and their guidance says if the fund manager earns a market-related fee and has more than 10%, then in that circumstance, there's control with the fund manager. Now, the reason why the IASB will never say that is because we know the first day we said that, all of the fund managers out there would go and make sure that they got 9.999999%, but they wouldn't get that one extra 0.1. So we've simply said you need to look at all the facts and circumstances. You need to make a judgment based on the way that it's actually being controlled, the way that the returns are actually generated. All right, so I've said power, I've said exposure. We sort of touched on it as we've walked through, that power without exposure or exposure without power is not enough. It's these two things that have to operate together. So the investor had the power, but not the exposure. The fund manager had the investor had the exposure, but not the power. The fund manager had the power, but not the exposure. You need to have both of these things in order for it to operate. You also need you must also have the ability to use that power. So you need to actually be able to apply the power to affect those returns. It's not enough if you can make the inconsequential decisions. An example of this, and quite a regular one that comes up in fund managers, is very often the investors have the right to choose the class of investments. So they can say that you can invest in bonds or you can invest in equities, but they have no right to make the buy-sell decisions. They have no right to choose which shares are sold and when, which shares are bought and when. So then you argue that they probably have the wrong kind of power. The power that they have is not the power that affects the variable returns. The power that affects the variable returns is in the hands of the guy making the buy and sell decisions. So very often you have to look, you have to exercise judgment about where these elements of power sit. And a good example of power without control is agency agreements. Agency agreement says, I give you the right. I say to you, go out and buy and sell things for me. But the money that you make from that comes back to me. Okay. I have the decision to kick you out of that job, to say I'm firing you at the moment, to exercise a kick-out right. So all I've actually done is I have delegated my power to you with the right to take that power away at any time. You're acting in that relationship as my agent. The power still sits with the person who has delegated the power, not with the person who is exercising the power on a day-to-day basis. So, example, investor purchases fixed assets funded by debt and equity instruments. The equity instruments are issued to a number of investors. The equity tranche absorbs the first losses. Okay. Again, I'm sure this is a type of example you guys are familiar with. You would have seen these are the types of things we saw a lot in 2000 in the period leading up to 2008. So I put together a vehicle. The vehicle does all sorts of things. It pays fixed returns to a whole bunch of people, and then right at the bottom is the risk layer. An investor holds 35% of that risky layer of the equity tranche. That same investor. Now, usually this would be the bank. So the bank puts a whole lot of its financial assets into a vehicle. The vehicle is funded by a whole lot of outside people. So think mortgage securitization in this space. So the investors come in, but their risk is fixed because somebody at the bottom is taking all of the risk. That somebody at the bottom is the bank. They hold 35% of the return. They also manage the asset portfolio, so they're managing those underlying mortgages, deciding how to react and how to treat those underlying mortgages. And they receive a market-based fee as well as performance fees. So now this comes back to your example. Now we're thinking a little bit about your example, because now in this circumstance, the fund manager, the fund manager at the bottom of this, owns 35% of the equity tranche, so they have variable returns from the equity tranche, plus they're receiving fees. So they have exposure to variable rate. They have exposure to variable returns through their 35%. The fees are almost neither here nor there. That's almost irrelevant because that's just a fixed amount. But they got the 35%, that's exposure, and they are making the decisions. They have control. And that 35%, as I said earlier, might be 20%. It doesn't need to even be as high as that. Fund manager establishes, markets, and manages a fund. This is my fund manager earlier. I started the fund. I got it going, I market it, I do all that work. I have discretion about the assets. I decide which assets to buy and which assets to sell. I hold 10% interest in the fund. Okay. So now it's getting a little bit more dicey. I have variable exposure. I'm exposed to the underlying. I manage all of the process. I receive a market-based fee for the services. So if I'm looking at this fund manager's got exposure to variable returns, plus they have control over the activities. In this circumstance, I'm probably on the verge. So I told you about the big audit firm that said 10% is enough. Other people seem to think that 10% is not quite enough. I need to look at other things. The first thing that I would look at in this space is, can the investors fire the fund manager? The investors can if the investors can fire the fund manager, fire manager, you see, I knew I shouldn't have had that half glass of wine at lunch. Fire the fund manager, then I have a circumstance in which I would probably say there is not control. But if the fund manager can't be fired, this is very, very close, because there are variable returns. And 10% of the variable returns, 10% is a significant number. It's enough of a number to make a difference. So certainly in this space, you start thinking about it and you start looking at the ancillary information, the information surrounding the transaction.
Darrel, maybe also it depends at what point in time we are, because if you have a new fund, which is created by a fund manager, and you're in the first year of commercialization, there's probably a chance that you're going to be above 10%, but that you don't intend to keep more than 10%. You just have put seed money there to make sure that you can actually buy assets and manage those assets, but your objective is to get 95% of the assets detained by other people rather than you.
We actually specifically give a little bit of guidance about that, where we say that's important. And that's not the only important circumstance, in fact, because what you very often find with fund managers in this sort of space is they also play the role of market maker. So they have a fund with 100%, they're holding 5% of it. But if a big investor comes along and says, I want to sell my 10%, rather than sell the underlying assets, the fund manager will very often say, well, I will buy your 10%. So now suddenly I've gone to 15%. But my intention in those circumstances is simply to remarket it. So it needs to be, you need to look at why you hold the 10%, what the objective is behind holding the 10%, or the 15% or the 20%, and whether that's a permanent relationship or simply a temporary one and that talks to whether you expect to have an exposure to the underlying, or whether your pure reason for holding that is to play that role of market maker in this space. And usually it is about the market making. I made the point right at the beginning, though, where I said that the important thing in these examples is look at the amount of judgment that's been exercised. Now, what we're seeing already in this space is that a lot of the audit firms, a lot of regulators and jurisdictions are becoming involved in specific transactions and saying, we think this needs to go this way or that way. From our perspective, no problem with interpretation where interpretation applies to a specific transaction. So a regulator comes in and applies their judgment, applies their oversight in the context of a specific transaction. But the reason why we make this judgmental, the reason why we want people to exercise judgment in this space is we think that every single transaction is different. Every single approach is different. And what we don't want to have happen is what we think would be counterproductive is when regulators or audit firms issue blanket rules. 10%, that's the rule. Because as soon as you issue a rule, that becomes practice and that becomes the thing to avoid. Then I can do absolutely anything as long as I've got 9.9999%. My objectives then change in that circumstance. Fund manager has, in fact, I'm going to skip this one. I'm going to move right on, I think. Well, let me actually go into this now. All right. So what I've said up to now, slide 37, sorry, I'm jumping around a little bit. Important facts here, the right to remove the manager. So look at that. A fund manager does not have control if he can be fired. does not have control if he can simply be moved out and a new fund manager moved in. It doesn't matter how much exposure he has to the variability. So that's something to look at. Aggregate returns, so adding together all these different returns that fund managers are getting from different places. To say a common structure is for the fund manager to get 2% of the total asset value, plus 10% of the return above a certain hurdle, plus a return on their own investment share. You're aggregating all three of those factors. When you get to the end of that aggregation process, the number you end up with might be a significant exposure to the variability of returns. So these are the measures that you have to weigh up, the process that you have to have a look at. Mentioned earlier, the IASB is paying quite a lot of attention to emerging practice in this space, and to an extent that we might need to, that it might make sense, we will obviously get involved to help that emerging practice along the way. So recapping on a couple of things, we've talked about de facto control. De facto control means that I have control even though I own less than 50%, even though I have less than that full amount of control. And that will depend on the size of the holding relative to voting rights. It'll depend on things like potential voting rights. It'll depend on other contractual rights I have that allow me to exercise my rights in a particular way. Potential voting rights are a really important part of this, because so often we focus on the actual voting rights and don't look to those potential voting rights. And remember the point I made earlier about when you're sitting around a table and the person at the other end of the table has the right to take you out of the transaction. Even if you've got 50%, you're going to listen to what that person says because you know they have the ability to take you out. So potential voting rights are really, really important in this space. Mention those two things before I got into structured entities, because structured entities are an important part of the model. For those of you that were involved in the old, or who know IFRS as it's existed before IFRS 10 came along, you will know that for structured entities we had SIC 12. SIC 12 was an interpretation, and what happened was SIC 12 told you how to deal with things like autopilots and all those sorts of things. The problem with SIC 12 was that we had our normal guidance, and then we moved to structured vehicles, structured entities, and we had to apply this new guidance. And people never quite understood where the one set of guidance began or ended and where the other one began. IFRS 10 just combines it and says you must look to exactly the same sorts of things that you were looking at when you were applying it to all sorts of other things. So if an entity is structured, if a bank puts together a specific vehicle, have a look at the purpose, have a look at the design. It's entirely possible, and one of the best tricks with banks, I mentioned the Guernsey Lifeboat Association earlier. The trick with the Guernsey Lifeboat Association was to autopilot that thing, to design it in such a way that it could only achieve one purpose. And I promise you that purpose was never to make the Guernsey Lifeboat Association rich. That wasn't the purpose of those vehicles. So have a look and understand what the design is, have a look at the purpose. Look at the relevant activities. What are the activities that are actually going to make money? And see if those activities are controlled, that's easy. If those activities have been designed in such a way that they are on autopilot, that tells you something about the structure you're looking at. Look at how those decisions are made, who has the ability to make those decisions, who's exposed to the variability. So the important part about IFRS 10 is it's one set of principles. We don't have multiple sets of principles for different circumstances. Now we've got a couple of examples here. And I think I'm probably going to skip these examples, because well, skip certainly this example anyway. This is simply the one that we talked about with an asset manager, two people, equal rights, but one of them has been given the control. So even though they have equal rights to the underlying return, one of them has more control than the other. So the one who has more control is the one who is actually the person in control of the entity. Okay. Don't you like the way I said I wouldn't deal with the example and then went and dealt with the example anyway? I can't seem to help myself. All right, agency relationships. Talked about them a little bit, but you need to consider all of the following. The scope of the decision-making authority, the kick-out rights. So I mentioned earlier, I said I gave you complete carte blanche. I said, here's my money, go out and manage my money, do what you like, buy, sell, anything. But at any point, I can kick you out. Well, then you don't have control. You're simply my agent. You are simply doing what I have asked you to do. And it doesn't matter how much power you have while you're doing it. I have the ability to take my money back. The remuneration. It's amazing what you can achieve if you have the decision to remunerate the decision maker. You might have no other right except to pay the person who's making the decisions. Well, that's all you need. So look at how that remuneration gets decided. And then any other interest that the decision maker holds in the investee. So the example I had earlier again with the agency, have a look at all of those factors, all of those processes and the way they work. So delegated rights. I've got a responsible entity here that has all the decision-making rights in the particular trust, that manages the portfolio and decides everything about the portfolio, earns remuneration of 1% of assets and management plus 20% of the profits under a hurdle. So if I look at this, the responsible entity, the one in red, has control because they're actually making all of the decisions. They have exposure to the variable returns because they're an investee, they hold 20%, plus they get performance-related fees. Up until this point, what I'm looking at is a structure that tells me the responsible entity is the control or has control. But there's one element there, the kick-out right, the fact that they can be removed by the other investors. Immediately, this is now a delegated authority situation. It's an agency type of situation. All of this control argument, all of this discussion about control is about consolidation. It's about identifying something that's a subsidiary and then consolidating that subsidiary. Now, we don't deal with with consolidation in IFRS 10. Consolidation actually occurs in a standard called IFRS 3. So what IFRS 10 says is, work out if you have control. If you have control, and if you satisfy if you have that control, if you've ticked the box control, we expect you to consolidate. And what consolidate means, and I think we dealt with this last year, but what consolidate means is I take all of the assets and all of the liabilities in the underlying entity and I add them onto my assets and my liabilities. Okay. So thinking about the fund manager with an underlying fund, if we argue the fund manager controls the fund, then all of those assets in the fund come onto the balance sheet of the fund manager, and all of the rights of the other investors become a liability of the fund manager. If the fund manager doesn't have control, okay, then none of the assets come on and none of the liabilities come on. So it makes a very big difference. Because it makes such a big difference, and because we wanted to think about all of the issues, we realized that that circumstance with the fund manager actually doesn't quite feel right from a consolidation perspective. It can feel quite odd. And if I think about somebody like a private equity company, a private equity company goes out and it buys shares in an underlying company. It holds those shares for a period of time. It controls the underlying company. But its intention with those shares that it's bought is to sell them. It's simply going to bring them in, hold them for a little bit, and move them off. So why should a company like that actually be considered to have the underlying assets on its balance sheet? I'll give you an example again. In First Rand, the company that I worked for, was a very strong company in private equity. It was one of the biggest businesses we bought. Okay, but we were still a bank. Okay, so primarily we were a bank. And so what we expected our financial statements to reflect was bank things we did from a banking perspective. The problem was, because we had this private equity relationship, and because prior to IFRS 10 there was no choice, we had to consolidate. The result was our bank balance sheet had chickens on it because we invested in chicken farms. Okay. It had dustbins on it because let me explain what a dustbin is. These wheelie bin things that people wheel around. We formed a company a private equity thing that helped get wheelie bins sorted for the municipalities. So we had wheelie bins on our financial statements. Now, none of that told you about our business. We weren't chicken farmers. We weren't dustbin manufacturers. What we were was a company like a bank that invested in underlying subsidiaries and sold them when the time came, private equity operations. Now, fortunately for us, in that specific circumstance, it was such a small part of our business that it didn't really matter. It didn't matter that we had the chickens on because you couldn't find the chickens on our balance sheet. They kind of got lost in all the other numbers that were there. But if that was the only business we were doing, you would have understood nothing about our business by looking at our financial statements, because you would have seen chickens and you would have seen wheelie bins and you would have seen all of the other things that we weren't really doing. So when we designed IFRS 10, we said we had to make an exception to this consolidation rule. And the exception we made was for investment entities. Investment entities are entities that invest for returns from investment income or capital appreciation, and who consider their investment performance on a fair value basis. Now, what does that all mean? It means that if I qualify as an investment entity, I don't show the chickens, I show the fair value of the shares that I bought in the chicken farm, even if I control that chicken farm. Okay. That helps people who are looking at my financial statements understand what is happening in my financial statements. Helps them understand the nature of my business. We've restricted this only to investment entities. So importantly, my old bank would not have got relief here because it wasn't only investment entity. It was actually a bank with a little bit of an investment entity arm, but mostly it was a bank. And because it was mostly a bank, it couldn't benefit from this. But our private equity subsidiary could benefit. And it could benefit because it in its own right was an investment entity, even if the bank couldn't say it was an investment entity because it had too many other businesses. So the principle here is to try and give accounting that makes sense for companies where it makes sense for those. Not sure you'll see too many investment entities in the dealings you have, but where this will come up is fund management vehicles that are set up, for example, by insurance companies, mutual funds that are set up. Very often the mutual funds, the private equity type funds, are standalone funds. They qualify as investment entities. They use IFRS. Under previous accounting, they may have had to consolidate. Now they no longer have to consolidate because of this. Yes?
Have I understood right that if a bank wants to circumvent this kind of rule, because obviously it's not an investment entity only, it could set up some kind of fund?
So what is important? So,
Okay.
no, so it's unfortunately not that easy, because otherwise we would have had a plan already. Okay, so what happens is the fund, in its own right, when it produces its financial statements,
Yes, of course.
okay, can use this because it is an investment entity. But when the bank consolidates the fund,
Okay.
it has to go back to consolidation principles.
All through the chicken farm.
All the way down to the chicken farm.
All through the chicken farm.
Absolutely. So the chickens will not be on the fund's balance sheet, but they will be on the bank's balance sheet.
Okay, thank you.
And I say the rationale behind that is because a bank this is only a very small part of its business. And because the moment we thought about this, we saw here was a wonderful opportunity for banks. All I would do is I would put all my secret financing, funny stuff into my fund, and then I wouldn't show it on my balance sheet. So we couldn't do that, and it's probably for a long time going to be a step too far. We've stopped with investment entities at this step, and we'll probably say stopped at this step. Okay, judgments and estimates, I'm not going to go into too much detail. We've spoken about this all the way through. IFRS 10 is a judgment standard. Auditors, regulators, capital market regulators are going to spend a lot of time involving themselves in judgments in this space because it really is an important judgment standard. Okay, so that's 10. Moving on to 11. 11 deals with joint control. It talks about the accounting of parties to a joint arrangement. Now you're going to hear a lot of joint coming through here. We have joint control, we have joint arrangements, we have joint ventures, and we have joint operations. All of this sort of feeds into a South African environment where the term joint means something you smoke in the park out of sight. But let's leave that aside for the moment. All right, so we have all these joint things, and I'm going to define what each of them mean. A joint arrangement is simply the overall contract that you have. It's when two parties enter into an arrangement that gives each of them the ability to have joint control over something. So I can't make a decision without you, you can't make a decision without me, we have to make the decisions together. In dealing with joint arrangements, we have defined two different types. The first one is a joint operation. A joint operation is where both parties have access to the underlying assets and they have responsibility for the underlying liabilities. So there's not a vehicle between them. They have direct access to the underlying assets, access to the underlying liabilities. This sort of thing very often happens when you, for example, I have a building and somebody else has building management rights or rental rights or something like that. So I say, well, I will put my building into the arrangement. You bring your ability to get tenants, and we will operate together as a joint arrangement. But that building never becomes your building. It's still my building. And your business that arranges tenants is still your business that arranges tenants. So we each have our own assets. We each probably have our own liabilities. That's a joint operation. And the focus of a joint operation is the underlying assets and the underlying liabilities. Okay. So that's the first type. The second type is a joint venture. A joint venture is when we have only the right to the net assets. So what happens there? I sell my building to a company. You sell your rental business to the company. Both of us now own 50% in that company. In essence, you own 50% of the building now, and I own 50% of your rental business. So we've got that joint arrangement that's come about, and because it's a joint arrangement in that space, we call this one a joint venture. And that's the distinction between the two. If the joint operation is structured through a separate vehicle, then I have to look really hard at this. So what I've done now is exactly what I said. I've sold my building into that separate vehicle. You've sold your business into that separate vehicle. On the face of it, that looks like a joint operation. Like a joint venture. Okay. But now I need to analyze it. I need to look at the rights and obligations between the parties. I need to say, have we come into an agreement that says that at the end of the process, I get my building back and you get your business back? Well, then it's back to being a joint operation. Okay. I need to look at the legal form of the vehicle. So the vehicle I formed might be a trust, and in some countries, trust law says that you always keep, as the beneficiary, retain the rights to the underlying assets that you've put into the vehicle. So that legal form might tell me something. A partnership is a legal form, but a partnership usually says, I keep my assets, you keep your assets. I keep responsibility for my obligations, my liabilities, you keep yours. So when there is a separate vehicle, I need to look at that separate vehicle and decide whether I have a joint operation or a joint venture. I need to look at the rights and obligations created between the two parties in that arrangement. If there is not a separate vehicle, then there's no question that that is a joint operation. Because if there's not a separate vehicle, then somebody has to own the assets. Somebody has to take responsibility for the liabilities. A non-existent, nobody's going to lend a non-existent thing money and hope this non-existent thing will pay them back. They will then be lending money to the parties to the joint arrangement. The assets will belong to the parties to the joint arrangement. So, just over a recap, if there's not a structured vehicle, a separate vehicle, it's always a joint operation. If there is a separate vehicle, you have to look at the separate vehicle to decide whether or not it's a joint operation, whether it's a joint operation or a joint venture. You can see I'm getting myself confused with these. Okay, so an example. I have a separate vehicle, so I've passed the first test. I have the vehicle, jointly controlled by two parties. The purpose is to construct and sell residential units. Okay, so we're going to be building houses somewhere. Neither the legal form nor the contractual terms give the parties rights to the assets or obligations for the vehicles, for the liabilities. So neither of the parties has got any right that goes through the vehicle into the underlying assets and liabilities. The equity that has been contributed is sufficient to buy the land and raise the debt. So we've both put enough money into the vehicle that it can now operate on its own. The proceeds will be used first to repay the debt, and then any remaining profit is distributed to the parties. So up to now, joint venture is very definitely a separate vehicle. A separate vehicle can operate on its own. It's there, off you go, no problem. The last line kind of makes it a bit more difficult, because the last line says, I've provided a guarantee. Now, what does a guarantee mean? It means that the joint venturers are subjecting themselves to some of the risk of the underlying vehicle. But we said that a guarantee is a normal thing. It doesn't actually change your relationship with the company. There are plenty of commercial guarantees out there. Banks guarantee companies. It doesn't mean that they jointly control the company. It doesn't mean that they have a right to the underlying assets and liabilities of the company. So because a guarantee is a normal commercial instrument, it doesn't change the nature of the relationship. This is still a joint venture. It's still something where the two parties only look at the net assets of the company, not at the underlying gross assets. Second example, two parties jointly establish an entity. Again, jointly establish an entity, so I have a separate entity. They have joint control, so we know we're in this process. What we're going to do here is we're going to mine ore. Okay, the parties have agreed that they will purchase all of the output from the entity in a ratio of 60-40. Okay. The entity cannot sell the output to third parties, and the price is set by the parties at a level to cover production and admin costs. So think about this. Who's actually carrying the risk of the underlying assets? Who's benefiting from the underlying assets? It's the two parties directly, because they're buying it at cost. If the cost of the vehicle goes up, they will simply pay more. If the cost of the vehicle if the cost to produce the ore go down, they will simply pay less. All they're doing in this circumstance is using a vehicle as a mechanism to control the underlying assets and liabilities. So this is a joint operation, even though in this circumstance there is a separate entity in place. The parties have entered into an arrangement that says the underlying vehicle that exists will never make a profit or loss on its own account. It will never be responsible for its own debts or its own assets. Those assets and those debts are managed for the benefit of the parties. This thing can never operate on its own, therefore it's a joint operation. You're seeing where the judgment comes in here too. So IFRS 11 is also going to have judgment. As you get further and further away, as the entities get further, you start to ask more questions. If, for example, the output was being sold by the venture, was being sold by the joint operation at market value. If it's being sold at market value, then the underlying vehicle has to make its own profits and losses. It survives on its own profits and losses. It will be able to fund its own debt and repay its own debt because it's got money coming in. In that circumstance, you're moving more towards a joint venture. But because in this circumstance it can't make a profit and loss, it's probably a joint operation because it can't be responsible for its own activities. Sorry, there you go.
I'm confused here whether this is a joint arrangement or there is a control existing from one of the sides that owns 60% that has 60% of the ownership interest in the legally established separate entity.
So,
Purchases 60%.
absolutely. So here's a very good question. What the question was, just if you didn't hear it, was that given the fact that there's a 60-40 relationship on the slide, doesn't that imply that one party has control? In other words, this is not a joint control situation, this is a control situation. The reason why it's not is that at the end of the day, control is decided by who is actually making the decisions about the company. Now, in this circumstance, the fact that one company gets a greater degree of the return realistically here, both companies actually have, to use the terms we used earlier when we were talking about IFRS 10, both companies have exposure to variable return, and that exposure to variable return is in the relationship of 60-40. But that means I've got two parties who've got, so now I need to look at which of the two parties has got control. The assumption in this particular example is they make all decisions together. So no party can make a decision without consulting with the other party. So the 60-40 becomes a little bit of a red herring because it's actually about the returns, not about the control. And so again, it raises a really interesting point, is that you have to look at both elements of the equation. It's not enough just to have one, you have to have both. Right, the final part of the equation, if you remember on my first slide that set everything out, this was the slide, this is the line across the bottom. This is about disclosure requirements. Now this is when I mentioned earlier about Hugh talking about IFRS 7. It is a principle-based disclosure standard. Now principle-based disclosure standards, IFRS 7 as I say is another one, are things that preparers have been asking us to do for a very long time. Preparers love the idea of principle-based disclosure standards. The reason they love them is because conceptually what many preparers have said is that if you look at my financial statements, first rand, and I'm pretty sure I told you this last year, so I apologize to the people who were here last year because you've probably heard it before, but first rand's financial statements used to be 400 pages long. We always said that on the second last page we were going to put a paragraph into the financial statements that said, if you're still reading now, phone this number and we'll take you out for lunch. Okay. Because we knew that nobody reads the note on page 398. Okay. The reason why we didn't do it actually is because we were terrified that we might have to go out to lunch with the kind of person who did read to page 400, and that Rory does quite a lot. But the reasoning, the logic behind that was that because of the fact that people very often see disclosure principles as disclosure rules, companies end up disclosing everything. And everything means even the stuff that companies think is absolutely useless. So by the time you're getting to page 398, you're probably getting to the really, really useless stuff, the stuff that nobody's interested in, because you stick it at the back because people tell you you have to. A New Zealand university did a study a couple of years ago. And what they were trying to find out is whether disclosure in financial statements follows a jurisdictional pattern. In other words, all New Zealand companies do one thing, all South African companies do a different thing, all European companies do a third thing, or whether it followed industry patterns. In other words, all mining companies across the world did one thing, all banks did a different thing, all software companies did a third thing. What they found actually surprised them. They found that there was no correlation between jurisdictions. There was no correlation between industries. It all came down to who your auditor was. So if your auditor was PwC, you followed the PwC manual. If your auditor was Ernst & Young, you followed the Ernst & Young manual. That's what's wrong with disclosure. People have thought about disclosure as a rule. They've said, how do I do this rule? They've gone to the manual of their auditor and they've ticked all the boxes. So preparers have said to us, this is a problem. We need you to fix the problem. IFRS 7 and IFRS 12, perhaps more so IFRS 12 than IFRS 7, have started to fix the problem. Because instead of giving a rule, instead of saying this and this and this and this and this and this is what you must disclose, they say, think about the risk. Think about what it is that is the objective, okay, and then disclose that. So I used the example earlier when we were talking at lunch. I know my users, one of my users is my regulators. If I'm a bank or if I'm an insurance company, I know those are my... So what I should be doing when I sit down and decide what to disclose is I should say, well, what do my regulators want to know? What is material to my regulators in understanding the risk of my company? Now, this is one of those interesting ones where preparers said, we want, and then we said, here it is, and they said, oh, no, we didn't want that. Because what's happened, disclosure used to be the responsibility of the most junior person on my staff. It used to be the responsibility of the first-year guy who just arrived. We said, there's the PwC manual. Tick and make sure we've done everything in the manual. The most junior guy in the team can't decide what my regulators want. The most junior guy in my team can't decide what's important in my company. So preparers are suddenly waking up to the fact that this thing that they wanted, this thing that they asked for, is actually pretty tough. It's actually a pretty difficult thing for them to deal with. And that's good, because hopefully what it'll mean is we won't get 400 pages of financial statements. We'll get 250 pages of financial statements. And the 250 pages will contain the important stuff. And if a bank, if an insurance company, if somebody else leaves something out, if they choose not to put it in, they can't then say afterwards, but the PwC manual didn't say I had to do it. Now they've got to say why they thought that important thing wasn't important. So you put them on the spot. We make them responsible for doing things. And by the way, I should mention, I talked about that little note on page 398. One thing I've discovered in looking at financial statements since I arrived at the IASB is that we missed a trick completely. The clever companies put all the good news on page 100 to 150, all the really boring stuff from about 150 to 300, and then the bad news comes right at the end, and they hope the people have stopped reading by then. So we did miss a little bit of a trick there. Okay, IFRS 12, what's it about? It covers all of these things: subsidiaries, joint arrangements, associated, and unconsolidated structured entities, those things that are outside of the space. The disclosure objective, this objective I've spoken about, is you must disclose information that helps users understand the nature of and risks associated with an entity's interests in other entities. So it's a risk disclosure. It's telling you what the things are that the company is exposed to. You also need to talk about the financial effects of those interests. So now you've at least got a statement that helps you. If I'm looking at something, I say, well, it doesn't tell you about the nature and risks. Okay, the chickens don't tell you about the nature and risks potentially. It tells me something that I can leave out of the financials, leave out of the disclosure. Meeting those objectives means that you have to also talk about the significant judgments and assumptions you make, and you have to give information about subsidiaries, joint arrangements and associates, and also the unconsolidated. Now here's the big sentence. This is the thing that scares everybody. So all the other standards we say is disclose A, B, C, and D. Now we get this thing, yay, it says, and any other information that is necessary to meet disclosure objectives. That's the sentence that gives people sleepless nights if you're a preparer, because that tells me I have to think about what I'm disclosing. That's the really important one. From a regulator perspective, particularly a capital market regulator, this becomes an important issue, because you're allowed now to look beyond what the standards required and say, actually, the standard required A, B, and C, but D was additional information necessary to meet that original objective. So why did you not disclose D? Why did you not think about this additional information? So subsidiaries, the kind of stuff that we've given, and we give examples, and this is composition of the group. So how the group is actually put together, what the involvement is of the NCI, and NCI for the uninitiated in accounting acronyms is the non-controlling interest. The non-controlling interest, so it's the parties, that's what we used to call in the olden days the minority shareholders. The shareholders that come in at the side of various subsidiaries, they don't exercise control, but they are part of the process, and usually they have rights. So determining and explaining what the rights of those are. You also need to disclose any significant or unusual restrictions. Now this is really, really important if you're regulators. If you're a regulator and you're looking at a company, and that company says in its consolidated returns that it has free cash of $10 million. It's got $10 million worth of free cash. And you can say, cool, $10 million is enough to meet your liquidity arrangements. But if those $10 million are trapped in a subsidiary, and the subsidiary is regulated in a different country, and the different country says it can't release that $10 million, well, that is an unusual or unexpected but significant restriction. And as a regulator, you want to know about it. As an investor, you want to know about it, because those funds are not available to be used. They're there, they're in the group, they can't be released. So you have to actually disclose that. And then use the same terms we used earlier, the nature of changes in risks associated with those structured entities. Unconsolidated, the nature, extent, and financial effects of the interests. So those special purpose vehicles that I concluded in example on slide probably 36, that we decided you did not have to consolidate, where you had the credit default swap, and we decided you probably didn't have to consolidate it. You think you got away with it, here it comes back. Now you have to give information to the users of financial so they can understand what the nature is of those unconsolidated entities. The nature of the risks involved, the carrying amount of the assets and liabilities that are involved there, and the maximum exposure to loss that you can have relative to the carrying amount. So the big excuse here is I don't control it, but I'm still exposed to risk. And if these assets once resided on my balance sheet and have now moved off my balance sheet into a structured entity, the standard requires that you disclose the information about the loss that you might be exposed to if something actually goes wrong in this space. Joint arrangements and associates, exactly the same thing. We're trying to get through to that nature and extent of financial effects. Questions? Any questions anybody has so on IFRS 10, 11, and 12? I will say that IFRS 10, 11, and 12 have created havoc wherever they have landed. They are very difficult standards to apply because what they have done is they've taken something that was previously rules-based. 50% plus one share was a subsidiary. 20% plus one share was an associate. They've made rule-based decisions into principle-based decisions. The effect of putting these standards in place is that companies have had to go through what we've always talked about as the project management cycle. At the beginning, people thought, this is a breeze, this is easy, no problem. So there was uninformed optimism. We can do this, it all sounds very logical. Then they started digging into all of their subsidiaries and all of the arrangements and all of the things that were happening in their lives, and they hit what we refer to as informed pessimism. They started getting the living daylight scared out of them when they realized just how complicated the arrangements were that they had. And mostly they're now emerging into the phase of informed optimism. They started to realize, understand the effect, seeing that the impact is not as big as they thought. And the word that I used right at the beginning, realized that the principles here are largely common sense principles. You think about them in a common sense way. And once they get to that, you realize that you know, as a company, you know if you control. You know if you've actually put in place an arrangement that means you control something. So think about it that way and it's easier to apply. But this is something that's caused a lot of grief in a lot of companies across the board. I think there was an EFRAG study that identified that there were 100,000 new subsidiaries that were being considered by the insurance industry in Europe, just the insurance industry. Any other questions?